Europe just lost nearly €1 billion in a single decision. China didn't fire a shot. It didn't need to. All it took was one word: pork. And now, thousands of European farmers are waking up to a reality they never saw coming. After 18 months of silent investigation, China dropped a bombshell that echoed across the Atlantic and straight into the heartland of Europe. The verdict? European Union pork, and everything attached to it, has been dumping products into Chinese markets. The consequence? Anti-dumping tariffs as high as 19.8%, locked in for 5 years, targeting every major EU pork exporter without exception. The numbers tell a brutal story. European livestock farmers are staring down losses that could reach €800 million. But this isn't just about money. This is about power, leverage, and a message being sent loud and clear. If China can stand firm against the United States in trade wars, Europe should expect nothing less. And here's the part that should make Brussels nervous. This pork decision? It's likely just the opening move. So what's really happening here? Why did China choose pork as the battleground? And what does this mean for the future of trade between two of the world's largest economic blocs? Let's break it down. The pork paradox: how Europe fed China's appetite. China is home to over 1.4 billion people. Feeding that population is a logistical feat that most nations can't even fathom. And when it comes to meat, pork isn't just popular in China, it's essential. It's woven into the culture, the cuisine, the daily rhythm of life. In 2024 alone, Chinese consumers ate roughly 58 million tons of pork. That's nearly half of all the pork consumed on the entire planet. Let that sink in for a second. Half the world. Now, China produces most of its own pork. Its domestic hog farming industry is massive, sophisticated, and growing. But to keep prices stable, maintain competition, and ensure quality, China also imports a significant portion from abroad. And for years, Europe has been one of the biggest suppliers. In fact, about 50% of China's pork imports come from the European Union. Spain leads the charge, exporting around 540,000 tons annually, worth more than €1 billion. That's 29% of all EU pork heading to China. The Netherlands and Denmark follow, each shipping about 200,000 tons a year, representing roughly 8% of the total. But here's where it gets interesting. There's a cultural mismatch that actually worked in everyone's favor, until now. Most Europeans don't eat pork offal. Pig ears, pig feet, pork liver, intestines, these byproducts aren't exactly menu staples in Paris or Amsterdam. But in China, they're delicacies. Street food. Comfort meals. There's a thriving market for every part of the pig that Europe doesn't want. So for years, this was a perfect arrangement. Europe sold its premium cuts domestically, shipped the offal to China, and everyone won. European farmers had an outlet for products they couldn't sell at home. Chinese consumers got affordable, versatile ingredients. It was trade at its finest. Complementary, efficient, mutually beneficial. Until it wasn't. The investigation that changed everything. June 2024. That's when China's livestock industry quietly filed a formal complaint. They claimed European pork wasn't just cheap, it was suspiciously cheap. Too cheap, to be fair. By June 17th, China's Ministry of Commerce had opened an official anti-dumping investigation. For the next year and a half, investigators combed through data, interviewed companies, analyzed pricing structures, and compared European export prices to domestic market values. So what exactly is dumping? According to the World Trade Organization, dumping occurs when a country exports a product at a price lower than what it normally sells for in its own domestic market. It's not just about being competitive. It's about deliberately undercutting prices to flood a foreign market, squeeze out local competitors, and potentially monopolize the industry. The strategy is simple, but devastating. Sell low, drive competitors out. Then, once you've cornered the market, raise prices and control supply. It's economic warfare dressed up as commerce. And that's exactly what China concluded was happening with European pork. On December 16, 2024, the final ruling came down. Yes, the EU had been dumping pork into China, and starting December 17th, tariffs would begin. But this wasn't a blanket punishment. China divided European companies into 3 tiers, each facing different levels of duties based on their level of cooperation and the severity of their dumping margins. Tier 1 included just 3 sample companies. The lowest rate, 4.9%, went to Lara, a Spanish meat company that's been one of Europe's fastest-growing pork processors. They cooperated fully, and they were rewarded with the lightest penalty. Tier 2 consisted of companies that participated in the investigation and provided data. They faced a moderate 9.8% tariff, painful but not catastrophic. Tier 3? That's where things got brutal. Any company that didn't cooperate, didn't respond, or simply wasn't listed got hit with the maximum, 19.8%. No negotiation, no appeal, just the ceiling. And one company stood out above all. Vion, a Dutch giant and one of Europe's largest pork exporters. Vion and all its subsidiaries were slapped with the full 19.8%. Why? Because investigators found that Vion had the highest dumping margin of any company reviewed. Its pricing was so aggressive, so far below normal value, that it became the benchmark for the worst offenders. Here's the kicker. Any company not explicitly named in the investigation was automatically grouped with Vion. Same rate, same punishment. The logic was simple. If you weren't transparent, you were treated like the worst actor in the room. The fallout. Farmers on the edge. When the tariffs were announced, the first people to panic weren't the executives in boardrooms. It was the farmers. These are the people who wake up before dawn, manage herds of hundreds or even thousands of pigs, and depend on export markets to stay afloat. For them, this wasn't abstract policy. It was survival. Before the tariffs, pork sold to China for about $2.30 per kilogram. After the 19.8% duty kicked in, that price jumped to $2.84 per kilogram. On the surface, that's a 54-cent increase. Doesn't sound like much, right? But scale it up. A market-ready pig weighs around 110 kilograms. That means each pig now costs nearly $60 more to export, and European companies can't absorb that cost. They're already operating on thin margins. So the burden falls on the farmers. Imagine you're a mid-sized farmer in Spain with 500 pigs ready for export. That's a $30,000 loss per shipment. Do that twice a year, and you're looking at $60,000 in vanished income. For small operations, that's the difference between staying in business and shutting down. And it's not just about the money, it's about timing. Many farmers had already committed to export contracts. They'd invested in feed, labor, infrastructure, all based on the assumption that Chinese demand would remain steady. Now those contracts are underwater. Why pork? Why now? So why did China target pork, of all things? Because it's strategic, it's symbolic, and it's effective. First, let's talk timing. China's domestic pork prices had just started to recover after a long downturn. Farmers were finally seeing profits again after years of losses. But then, European pork kept flooding in at rock-bottom prices, dragging the market back down. Low prices aren't inherently bad. Competition drives innovation. But when prices are artificially suppressed by dumping, it's not fair competition, it's market manipulation. And in China's case, it was hitting the industry at its most vulnerable moment. Small and mid-sized Chinese farmers couldn't compete. They were hemorrhaging money. Many were on the verge of collapse. And the irony? Europe wasn't even sending premium fresh pork. Most of it was frozen cuts and offal, the lowest margin, highest volume products. These are the exact categories that Chinese processors rely on, but also the ones where profit margins are razor thin. When cheap imports dominate that space, it doesn't just hurt farmers, it crushes the entire supply chain. Slaughterhouses, processors, distributors, everyone takes a hit. And then there's the long-term risk. If Chinese consumers and businesses get too dependent on cheap European imports, domestic production loses its incentive to grow. Investment dries up, innovation stalls. And if down the line Europe raises prices or cuts supply, China's left scrambling with no domestic capacity to fill the gap. That's why this isn't about shutting Europe out. It's about leveling the playing field. The tariffs are designed to raise artificially low prices back to a reasonable range, close enough to domestic prices that Chinese farmers can compete, but not so high that imports disappear entirely. China still wants European pork. It just wants it on fair terms. The Dutch connection, coincidence or calculated? Now let's talk about VEON. Remember, this is the Dutch company that got hit hardest, the full 19.8%, and that raises an eyebrow, because the Netherlands hasn't exactly been friendly to China lately. Over the past few years, Dutch officials have launched anti-dumping investigations against Chinese electric vehicles, steel, chemicals, and renewable energy products. It's been relentless. So when China's investigation lands the heaviest blow on a Dutch company, it's tempting to see it as payback. Retaliation disguised as policy. But here's the thing. Anti-dumping cases have to follow the rules. They're governed by the World Trade Organization, and they require hard evidence. You can't just pick a target because you're mad at them. You need proof of dumping margins, pricing discrepancies, and market harm. And China had it. VEON's pricing was objectively the most aggressive. The data didn't lie. So even if there's political subtext, the legal case is airtight. Still, the optics are hard to ignore, and the message is unmistakable. If you come after China's industries, don't be surprised when China looks closely at yours. So if China's turning away European pork, where's the replacement coming from? Enter Russia. Russia might not be the first country you think of when you hear pork powerhouse, but it's been quietly building capacity for over a decade. It's now ranked in the global top 10 for pork production. And while it can't match the scale of China, the European Union, or the United States, it doesn't need to. China isn't trying to replace its entire pork supply. It's trying to diversify, and Russia offers a strategic alternative, one that's geographically closer, politically aligned, and eager for market access. Throughout 2024 and early 2025, Russian officials confirmed in multiple statements that they'd become a key supplier to China. The timing wasn't coincidental. As European Union-China trade tensions escalated, Russia saw an opening and took it. For China, this is about resilience. Relying too heavily on any single region creates vulnerability. By bringing Russia into the mix, China gains leverage, reduces dependence on Europe, and builds a supply chain that's harder to disrupt. For Russia, it's an economic lifeline. Sanctions from the West have choked off many of its traditional export markets. China's demand offers a rare bright spot. And for Europe, it's a wake-up call. The pork market they once dominated is shifting, and if they want back in, they'll need to play by new rules. Let's zoom out for a second. This isn't just about pork, it's about precedent. China has shown it's willing to use trade policy as both a shield and a sword. It will defend its industries from unfair competition, and it will respond proportionally when others target its exports. The 800 million euros in losses facing European farmers? That's a warning shot, a demonstration of what happens when trade imbalances go unchecked. But it's also a test. Can Europe adapt? Will it negotiate, diversify, or double down? And more importantly, is this just the beginning? Because let's be honest, pork is a relatively small piece of the European Union-China trade puzzle. If Beijing wanted to escalate, there are bigger targets. Dairy, wine, luxury goods, automotive parts. The list goes on. For now, China's playing it measured. The tariffs are high enough to hurt, but not high enough to sever ties completely. There's still room for dialogue, still space for cooperation, but the clock is ticking, and the next move belongs to Europe. Trade wars don't start with tanks or missiles. They start with tariffs, investigations, and carefully calculated pressure points. And in this case, the pressure point was pork. China didn't choose it randomly. It chose it because it mattered to European farmers, to Chinese consumers, and to the broader question of who gets to set the terms of global commerce. The message is clear. Fairness isn't optional, and if dumping continues, the consequences will too. So, as European policymakers scramble to respond, as farmers calculate their losses, and as Russian exporters ramp up production, one thing is certain. The global food system just shifted, and the ripple effects are only beginning. Power doesn't always look like strength. Sometimes it looks like a choice, and China just made one that Europe won't forget. If you want to understand the real mechanics of global trade, the moves that don't make headlines until it's too late, you're in the right place. Hit subscribe, turn on notifications, and let's keep unpacking the stories that shape our world. Because the next decision, it's already being made.